tell you a little bit about KeyBank in case you didn't already know. We're the only commercial bank headquartered here in Cleveland. We're one of the nation's largest bank-based financial service companies. We have over $90 billion in assets, and we provide a wide range of services from investment management, retail, commercial banking, consumer financing, investment banking products and services to individuals and companies such as your small businesses like yourselves. We have over 1,000 branches, full service branches. We have over 1,500 ATM machines nationwide, over 16,000 employees, and then our website's www.key.com. I just want to share some of the objectives that I have today as a result of my presentation. I want to, number one, is help you to evaluate your business concern. If you don't already know what exactly that is, this discussion is to kind of help pinpoint it. That way you have a goal in mind, and then map out a plan to help you achieve that goal and find out what tools are necessary. It's going to be interactive in a sense because I want you to now, you came in with your hat as being business owners, small business owners. So now I want you to wear my hat today. You're going to understand what the underwriting team evaluates you as a small business owner when you go to apply for a loan. Okay, so we're going to go through a qualification exercise so that way you have a better sense as to what we look for and understand what the 5 C's of credit, and what exactly does that mean. In front of you, you're going to find one form in your folder. I provided all of you with a folder. You open your folder, there's going to be 2 sides to that folder. On your right side, you're going to find one that's headed Bank Solutions for Small Business. Okay? It's kind of the outline here. I would like for you to pull that sheet out. And the first thing, of course, what we're going to talk about is understanding what your business concerns are. Some small businesses have a concern regarding cash flow. How frequent are the receivables coming in as opposed to what are the outgoing expenses, whether they're overhead or just working capital needs. Evaluating and taking the time to review that and identifying that as, is it one of your primary concerns for your business. Collateral. Maybe having a lack of collateral, understanding what exactly can be used as collateral from a business standing point, a small business owner. Credit, understanding what us as a bank institution, what agencies, what sources of credit bureaus we use, and how does that play into you as a small business owner applying for credit, and what exactly does that entail? Is it just the report that we look at? Is that it? Or, I spoke of the 5 C's of credit. What you're going to find out is that there's more to it when I mention credit. That's just like a very broad description. So just to give you an understanding, when you as a small business loan applicant go to apply for a small business loan, whether it's a term loan or a line of credit, KeyBank's going to use Equifax. They're going to use Equifax for you as a small business owner, personally, if you're guaranteeing the loan, and as the business entity of itself. So you have a business credit report on your small business, which that'll be also from Equifax, and a personal credit report will be pulled, and that will also be Equifax. And you can go to Equifax.com, so that way if you want the opportunity to review it, it's something I would certainly encourage you to do. Another primary concern that I run across with businesses is benefits. Being able to afford either benefits for yourselves as business owners, or if you do have staff, being able to provide benefits and maybe in a no-cost way to give a little bit more attractiveness to your small business and add a little bit of value as a takeaway for being part of your being employed through your small business. Tax expenses. That's another concern. It's not something that we can always get away from, but there, I would always recommend that you partner up with your CPA and involve the bank that you're, quite frankly, the bank that you're partnered up with. If you have a small business account with a bank, it's very important that you really firm up the relationship with either the branch manager or the business banker. I realized that I failed to introduce myself here, but Glenn was kind enough to introduce me. Aridin Barrios. I am actually a branch manager located right in Ohio City, a little north of here, about a half a mile away. And in my capacity, I do my best to certainly understand my book of business and the small businesses and help understand their industry and what their operations are like, and vice versa. The expectation is for me to understand, and from your point of view is you need to know what your concern is, what your small business concern is, and help me understand that, so that way when I'm asked questions by our underwriting partners or our line of business partners, I'll be able to properly relay that information to them. As I mentioned before, the two objectives I touched on is evaluating your business concern and helping you to understand what we go through to qualify you as a loan applicant. So I want you to wear my hat today, and so that way you walk away understanding a little bit better as to what to expect and how to qualify yourself in advance, and to make sure your goals are to make yourself look better on paper when it comes to our qualification standards. And the last thing that you're going to walk away with, which I don't know if we're going to have enough time to go through, but you can take it with you and assess yourself, is a self-assessment to kind of identify where you may stand at as far as your risk level. Are you high risk, medium risk, or low risk? Okay, but moving along, this Bank Solutions for Small Business here, just evaluating your net worth personally and as a business is a very important exercise that you should do, and it can be very basic. When you think back and reflect upon yourself, look at your personal assets, look at all your liabilities, and I'm not talking about like on a monthly budget. I'm talking about your balances as a whole. Look at all your personal assets, anything that you hold valuable and that you think you could sell and be able to make money off of, and any liabilities, so any debts, balances, and then figure out what your net worth is. If you're in a negative net worth, then certainly that's another goal that should be within your 1 to 3 to 5 year plan. You should always be working towards improving your net worth personally, and then same goes with the business. You want to count up your assets and know what you have as assets for your business, and then carefully monitor your liabilities, because again, we're going to look at your net worth as a business. Okay, so that's a very important component. Okay, here's the interactive piece that we're going to go through. It's pretty much, I titled it like Small Business Underwriting 101. In your right pocket, you're going to find a pre-qualification worksheet. It looks like this, except it's blank. It should be the second form there. Again, it's titled Pre-Qualification Worksheet. All right, and in your left packet, you're going to find a profit and loss statement, a balance sheet, and a description of who the client is. All right, and in this description we have Premier Cleaning Services. They started in '86. They operate as an S Corp. They're 100% owned by one individual, John Sweep. It's a full-service janitorial cleaning company performing commercial office cleaning. They were organized in 2006 to own the equipment, which is leased to Premier Cleaning, the operating company. They have a $100,000 line of credit with us, and what they'd like to do is get an increase of $50,000 to their line of credit. They also want to gain approval of a mortgage for $263,000 to purchase a building to house the operating company. So that'll be amortized maybe in about a 25-year loan. Okay, these are the facts, all we know about the client. Okay, so imagine yourself as a small business applying for this type of credit facility with us. First thing you're going to see on your pre-qualification sheet is the first thing you want to identify is the type of business. Are you set up as a sole proprietorship, partnership, LLC, S Corp, C Corporation? Once you've identified that, next thing you want to identify is your accounting method. And for this company, we have them set up as what? S Corp. Very good. So make sure you check that. I have two qualification worksheets. One's blank for you to take with you, and one for you to actually use today in the classroom. So don't hesitate to write over this with notes and everything. Accounting method. I'm going to give you guys this one. They actually don't operate off of cash method. They do the accrual method, which means that, of course, in case you're not accounting inclined, cash method is cash basis business only. Accounting method is where they actually have receivables and payables. Okay, so that may be paid 30, 60 to 90 days from now, and their payables may also be reflective of that. So their suppliers and so on. So we're going to place this client in the accrual method. Okay, the underwriters look at that. The industry, well, we're going to kind of skip the industry part. But we're going to just say they're in the green for right now. Green means that they're a safe industry as far as the bank is concerned. We don't proceed cautiously in that industry. We go through our normal steps. So it's not a takeaway. Relationship with KeyBank. Okay, this is very important. Okay, it can mean a world of difference when it comes to you being a small business owner, and let's say you bank with PNC and you come over to KeyBank and ask for credit facilities such as what we're identifying in this an example. It's an added bonus when you do your banking with the same bank that you're applying for credit, okay? Because they can actually see and understand your deposit account activity, and they understand more about your business. As you remember me mentioning, one of the biggest gaps of information that we try to close on is information passing from you, the client, me, the banking officer, to our line of business partners such as our underwriting committee. Our underwriting committee is pretty much when they receive that application, they're looking at black and white information. They're looking at paper, okay, and data. Okay, they haven't had an opportunity to discuss this with me probably, and even so, maybe they've received a paragraph or maybe 2 or 3 sentences from me, which you can't possibly describe you as a business and understand you as an operation, the history of your business in 2 or 3 sentences, or maybe even a paragraph, in my opinion. So banking with the same institution as you're applying credit for is an added bonus. So we look for that. So let's say in this case, Premier Cleaning Services is and does have a relationship with Key. And they've been a customer for at least 3 years. So that's an added bonus too. So please check yes on both of those. Okay, now we're going to get to what we describe as the 5 C's of credit. And then all of you, probably when you're thinking about credit, you're thinking about scores, maybe credit history. Well, we use some terms to describe the 5 C's of credit. We describe them as the character of the business, okay? The business and the business owners. So that's character, that's one of the C's. If you could write that down right next to the box where it says personal credit history, write down character. Next is capacity, and that's going to be under profitability, which is the next box down. So if you want to write down capacity right next to that box. So we're going to stop right there. We're going to assume that the personal credit history, that we don't have any reason to believe that the client has any personal credit history, personal credit problems. Okay, so I mark no on your box, and then what we generally look for is personal credit scores over 680 is ideal. Okay, but towards the end of this exercise, what you're going to find out is that we actually look for ways to mitigate any weaknesses that are shown on this qualification. Okay, capacity here is the next focal point. Profitability. Now I provided you with an income statement, so if I could have you take a look at the income statement. And the question here is, what we look for is, has the client been profitable for the last 2 years out of the 3 that they've been in business? So can anyone tell me, based upon the income statement you're looking at, have they been profitable? Have they shown a net profit? I see a nod. Okay. So yes, that's correct. So in this case, we're just going to assume that they've actually been profitable for 2 consistent years out of the 3 years they've been in, out of the last 3 years. The next question there is, has Premier Cleaning Services been profitable for the most recent year? So we're going to assume that this income statement we're looking at is the most recent year. So if they've shown a profit, so definitely that they were profitable. So that provides a good outcome for character, which is one of the C's of credit that we look at because of the personal credit history. It also provides, as far as one of the components of capacity, so far we have a bonus because the cleaning company has been profitable for the last 2 years out of the last 3 years they've been in business, and they've also been profitable for the most recent year. The next one is where we'll have to do a little bit of math, okay? So the next C of credit is conditions, okay? What's the condition of this company, and how do we go about finding out what that is? Well, we use the liquidity or current ratio to help determine that. So right there's a formula. It says current assets divided by current liabilities. So if I can have you take a look at the actual balance sheet now. We're going to shift from the income statement to the balance sheet. Can anyone tell me, with Premier, what's their actual current assets? What's their total current assets?
273.
Very good. Please write that in. 273,000 is their total assets. Next, you want to divide that by the current liabilities. So what are their current liabilities now? Take a look here. 31,000. Very good. So write in 31. You don't have to add all the extra zeros. Just do 273 divided by 31. And that, I'll allow you a moment to do the math on that. And please, somebody, as soon as they get the answer, share what that result is.
Something.
8.8. Okay, very good. Thank you. All right, so what we're looking for here is their liquidity ratio or current ratio greater than 1.3. We want it to be greater than 1.3. That's an indication that yes, it is. So you check off yes. So far from going through the personal credit history box, the profitability, the current liquidity ratio, all these are stacking up, which means that they're in favor. So far, this client is looking good as far as we're concerned, okay? So far, we don't need to look for any type of mitigation circumstances to kind of, look beyond that. All right, let's move on. Now, this is where it gets a little bit more intense. We're going to go back to the income statement, so if you can bring that in front of you. I want you to find where the client's net income is on that income statement. What's their net income?
147.
Very good. So we'll round it to 148. All right, take a look also, the next, we're just following the formula here, okay? You add in depreciation here. Are there any depreciation expenses from what you can see? First of all, did everyone find that net income? It's the same place we looked when we tried to see if this client was profitable. All right, so no depreciation expenses? No one's found it yet?
I don't see that.
Okay. You didn't find a net income? Anyone help us out? It should be on the last page. On the profit and loss, I have it highlighted in green. This is the income statement. So on the last page, that's where I circled it. I tried to be a little bit helpful. These were my own notes. So I circled net income for you. Okay? And I also marked it as A, Exhibit A. All right. So we add to it depreciation and interest expenses. So far, we don't see any depreciation. Do you see any interest expenses? No? Okay, very good. Fast. All right, next thing we want to take away is distributions. I'm going to give you this because I don't know if we're going to find it on here. Because we don't actually have the tax returns. I didn't bring that for you. I thought that was a little bit too intense to go through the tax returns, okay? So we're going to put, so far we've done 100, you should be writing this in, 148, just 148, we're going to say that's 148,000 plus 0, which is depreciation, plus 0 for interest expenses. And we're going to subtract distributions. We're going to subtract distributions of 50,000. And right now, and this is something else that I'm going to give you, is the fact that the client right now spends $30,000 a year in rent expenses. So they're looking to buy a facility here. So we're assuming that that's going to be taken away. So we're going to add that to their net income. So 148 plus 0 minus the 50 plus the 30, which is the 30,000, just so you know, is rent expense, which is going away, provided that they get favorable results on the financing with this loan. All right? Next, we're going to divide that by, well, so far, what does that get us? What's the total on that?
128.
128. Okay, write that down. 128. All right.
How we get that 128?
We took 148,000, which is the net income. We subtracted 50,000, which is a distribution, and we added back 30,000 because that's rent expense that's actually going away, provided that they get favorable financing for this building. Okay, so 148 minus 50 plus 30. That should equal 128.
You're just looking for cash flow generated by the business.
Yes, exactly. So this, what we're covering is the capacity again. Okay, that's one of the, the capacity to be able to repay this loan. Okay, so we're back to one of the C's of credit that we've identified, and this is, remember, we're going into this formula so you can understand how is it that we make this determination. You submit this application, and you get it back, and then you're wondering, okay, this didn't result in favorable results. Why? What went into this? So this is defining that. And this is a discussion you can actually use, with your banker to help identify where the weakness is and how can you mitigate past it. Okay? All right. So the next thing is taking interest. Is there an interest expense? We have already identified that as 0. Adding any long-term debt, I'm going to give you these, okay? And 5-year amortization of a line of credit. We're just going to say 36,000 is the long-term debt portion, and 20,000 is the 5-year amortization for a line of credit. So far that gives us 36,000 plus 20,000. That should be 50,000. So you take 128,000, or just 128, divide that by 56, or 56,000, and what do you get?
2 some.
Okay. Very good. And what are we looking for here? What is the, if it's 2 something, is it greater than 1.2? Then yes. Then that means that capacity to be able to take on this loan and a line of credit looks good so far. Okay? We're back to the balance sheet now. We want to look at what's the capital. Okay, that's another 5C of credit, one of the 5 C's of credit. We use the balance sheet to determine that. So we take the total liabilities in this case, and so let's see, total liabilities using the balance sheet. We're going to look at, what's the total liabilities, anyone?
125.
Very good, 125. We're going to add to it what they want to finance here, okay? So they want to finance a total of $150,000, which is their line of credit, because it's currently at 100, plus they want to increase it to 150, plus they want to finance a building for $263,000. So what's that get us? 125 plus 150,000 plus 263,000.
413,500.
413,500? Okay. Okay. All right. And then the next, we're going to jump to tangible net worth. What's the tangible net worth on this balance sheet? Total equity. 148,000. Very good. Okay, what's that give us? If you divide those two.
What are we dividing?
We're taking 125,000, which is the total liabilities, plus their line of credit, which is 150,000, plus the 263,000 they want to finance as far as the building is concerned. We're adding those together, dividing that by 148,000, which is their total equity. What's that give us? Very good. All right. Now, is that less than 3.1? Right. Okay, that's an issue then. Okay, we want to stop right here. This is a point where you would engage, myself would engage with the client and find out what's going on here. So if I dig deep and take a look here at, if I look at their, let me see here. If I look at the balance sheet, I notice under the long-term liabilities, there is an intercompany transfer for $93,564. Okay? That means that this building has actually, this company has actually done some type of private finance with the previous building owner. Okay, it's not done with a bank, but they've done some arrangements where, as a condition to buying this building, they've done some owner financing in this case. So my question would then be to the client, would that owner be willing to subordinate the loan that you're asking us for? And if the answer is yes, that's one of the mitigating circumstances where we can work past this part of the capital criteria that we're looking for. So what that means is we're going to change up this equation. We're going to, for the total liabilities, we're actually going to subtract the 94,000 from that figure and add it under the equities, okay, the net worth. So if we do that, if the owner that's financing this building is actually willing to subordinate, then that reduces the risk on the bank's part. So we're willing to move past that. So that'll get us in the appropriate, that'll get us less than 3.1, actually it'll get us about 1.8. And the very last component that we'll look at is collateral. We're going to look at what type of collateral you have. So that can range from accounts receivables to inventories to machine or equipment or actual real estate. And if you can see there's a multiplication times a percentage, okay? And those are what we use to identify, you know, how that collateral stacks up and how we can use it to help you on this loan. So that's kind of self-explanatory. You can actually do the math here. If you look at their financials here, I believe their accounts receivables should be noted in the income statement. So what I'm going to do, I'm going to give you, actually accounts pay, it's in a balance sheet. And I'm going to give you what that is. Their accounts receivables is $256,000. Okay, those are accounts receivables that are expected to be received within 90 days. So if we multiply that by 70%, the outcome is $179,000. They want a line of credit of $150,000. So the question is, what's the ratio based upon that line of credit of $150,000 versus their accounts receivable? They have $179,000. The ratio of that, if it's greater 1-to-1 ratio, then that's favorable results. Okay? So in this scenario, they would be favorable and we would be able to move past that. And last but not least, does the guarantor add strength to the loan? Okay? In this case, we're going to say that the guarantor doesn't necessarily add strength. The adding strength piece doesn't mean that they have bad credit or anything. They just don't have anything extra to give, like some additional personal assets, huge cash reserves, etc. Okay? So that's the exercise that I wanted to take you guys through. Keep your accountant close. Discuss tax liabilities, tax planning, personal and business. Include your branch manager in that discussion. Don't alienate your branch. You want to, it's a two-way street. If you want a relationship with your banker, you can't exclude them. No, you can't. You want that access to, like this gentleman said, the committee, but you're excluding him or her on certain, individuals, your accountant, your attorney. That hinders the relationship. It doesn't help close the gap. Understand the risks and weaknesses and include your branch manager. Understand your risks and weaknesses and include your branch manager to help you assess your risk position as a loan applicant, both personally and as business. Establish good relationships with local, state, federal contacts to explore supplementing business loans. Those are helpful as far as mitigating circumstances for funding for expansion, capital funding, storefront renovations, etc. And make sure your bank can provide you with both personal and business services. That adds to the value in the relationship. The more profitable of a client you are with the bank, so the more you're doing with that bank, that adds to Lamar's point. Who is this client? Well, this client has this. They have their payroll services with us, merchant services. They have cash flow services with us. Look at this relationship. This is a very valuable client.